Got it. I'll now create the passive path style script based on the provided transcript .tas. Robert Kiyosaki's crash prediction and guided entirely by the script.ni master framework. The script will use no more than 40% of the transcript, rephrased and contextualized, add 60% or more original insights, examples, and stories, maintain the passive path tone, warm, wise, calm, and story-driven, with clear, short, TTS-friendly sentences, be delivered in multiple parts if lengthy, ending with done at the final part. Let's begin. Part 1. You can feel it in the air. The headlines are louder, the charts are twitchier, and your group chat suddenly sounds like an economics class. Something's coming, and if you've followed Robert Kiyosaki for any length of time, you already know what he thinks it is. The big one. He's been warning that a financial storm is brewing, not just a market correction, but something deeper. A credit bubble inflated by years of easy money, government debt, and blind optimism. But here's the thing. Fear sells. And yet sometimes fear also saves lives. Today, on the passive path, we're not just repeating Kiyosaki's warnings, we're decoding them, separating panic from preparation, and showing you how to turn crisis into clarity. Because every crash has two sides, one that breaks people and one that quietly builds the next generation of wealth. Let's start with the story he tells, and the one history keeps repeating. The 2008 crisis wasn't a surprise. It was a slow-motion car crash that almost everyone saw but ignored. Cheap loans, rising house prices, people buying 3 homes with money they didn't have. When it all fell apart, the system didn't collapse because it was complex. It collapsed because it was fragile. Fast forward to today, the players have changed, but the script feels eerily familiar. Only this time, the excess isn't just in housing. It's in everything. Stocks, inflated by speculation. Governments printing money as if inflation were optional. Consumers treating credit cards like parachutes. And through it all, Kiyosaki's message is simple. Debt can make you rich until it doesn't. But here's what he doesn't always say out loud. Every crisis is also a teacher. It shows us where our assumptions are weak and where our courage is hiding. When the credit bubble pops, and yes, one day it will, you'll see 3 kinds of people. First, the panickers. They sell everything, blame everyone, and promise to never invest again. They think safety means silence. Second, the deniers. They keep swiping, keep scrolling, keep pretending the party isn't over. They survive, but never learn. And third, the builders, the quiet ones who prepare while everyone else argues. They're the ones who cut their expenses early, stack cash quietly, and buy assets when everyone else is selling. They don't wait for the bottom, they wait for clarity. That's who this video is for. Let's pause the drama for a moment and talk about what's actually breaking beneath the surface. The world's economy is like a balloon stretched by 2 hands. Governments on one side printing money and consumers on the other demanding more. The problem isn't that the balloon will pop, it's that nobody knows when. Low interest rates made borrowing look free. Then came the shock. Inflation hit like a forgotten bill. The cure? Raise rates. But the side effect? A hangover that lasts for years. Companies that survived on cheap money start choking. Mortgages reset, jobs wobble. And the same people who cheered the boom start blaming the system. Kiyosaki calls it the credit illusion. It's the belief that growth comes from borrowing instead of producing. And when the illusion fades, what's left are lessons. But if all you hear is doom, you're missing the real message. A crash doesn't destroy wealth, it transfers it. From the impatient to the patient, from the leveraged to the liquid, from the crowd to the contrarian, when panic hits, the world goes on sale. Stocks, real estate, skills, even businesses. The question isn't whether the storm comes, it's whether you're holding an umbrella or a shopping bag. So let's talk about building that umbrella. Preparation is not about predicting the crash. It's about making sure the crash doesn't predict your life. Most people build their finances like sandcastles. They look fine on sunny days, but the first wave of change wipes everything away. The builders, they dig deeper. They make choices that look boring now but brilliant later. Here's how they think. First, they study cash flow like a detective. Not income, not savings, flow, where it comes from, where it leaks, and whether it's working for or against them. You can't fix what you don't measure. A simple example. Imagine you spend $200 a month on takeout and 10 on investments. In good times, that feels harmless. In bad times, it's the difference between surviving and scrambling. When fear hits, the smallest leak sinks the ship. So step 1, tighten the ship before the storm. Cancel what you don't use. Negotiate what you can. Convert your spending into saving not because you fear the crash, but because freedom tastes better than fear. Second, diversification. Everyone says it. Few understand it. It's not about owning a little of everything. It's about avoiding too much of one mistake. When the market crashes, correlations rise. Everything falls together, except what's truly different. That's why wealthy people own cash, commodities, skills, and patience. Not just stocks and hope. Picture it this way. You're standing in a forest when a wildfire starts. Would you rather have one path out or 4? Diversification is those extra paths. It doesn't guarantee escape. It guarantees options. Third, recession-proof assets, not magical ones, practical ones. Real estate with strong rental demand, utility stocks that keep the lights on, food and healthcare companies that stay essential no matter what happens. These aren't glamorous, but they feed you when headlines don't. In every downturn, people panic sell the boring stuff and chase excitement. The rich quietly do the opposite. In 2009, while most investors cried over losses, a few were buying suburban rentals and water companies. A decade later, those boring moves looked genius. The lesson? Boring gets rich quietly. Panic gets poor loudly. Fourth, the hardest and most important investment, yourself. Skills are the only asset that appreciates during chaos. When everything else crashes, competence inflates. Learn how to sell, how to code, how to manage money, how to adapt. The world doesn't reward the strongest. It rewards the quickest learners. If you lose everything but keep your skill set, you can rebuild. If you keep everything but never learn, you'll still lose it. So buy books before you buy stocks. Build habits before you build portfolios. The market pays those who prepare their mind before their wallet. The truth is, we can't stop the next crash, but we can stop letting it own us. The system will bend again, maybe soon, and when it does, headlines will scream. Politicians will argue, people will panic. You'll stay calm, because you know that wealth isn't built in the boom. It's built in the wait that follows. That wait, the quiet, uncertain space after everything falls, is where real fortunes begin. Not with noise, but with patience. Not with luck, but with preparation. So take this moment as a quiet warning. Not a threat, not a prophecy, a reminder. Build stability now, so opportunity doesn't pass you later. The economy will reset. The question is whether you reset with it or ahead of it. This is the passive path. Stay patient, stay awake, and stay ready. Every generation believes their crisis is unique. But history repeats because human behavior repeats. In the 1920s, optimism filled the streets. People borrowed to invest, convinced the good times would last forever. Then came the crash of jobs vanished, banks collapsed, and millions learned the cost of blind belief. Decades later, it happened again. Dot-com stocks, housing bubbles, cryptomanias, all fueled by the same rhythm. Greed, euphoria, denial, regret. The faces change, but the lesson doesn't. Easy money creates lazy thinking, and lazy thinking creates painful lessons. When times are easy, discipline looks outdated. When times are hard, discipline looks wise. That's why you can't outsource your thinking to experts. The ones shouting the loudest rarely lose their jobs when they're wrong, but you lose your savings. The best investors aren't fortune tellers. They're historians with patience. They read the patterns, not the predictions. The credit bubble everyone talks about isn't the real danger. The danger is believing that someone else will fix it. Governments print, central banks adjust, but every lever they pull has a cost. You can't inflate forever without deflating something else. You can't spend endlessly without paying later. It's like heating one room by burning the walls of another. Eventually the whole house weakens. That's the part of Kiyosaki's warning that matters, not the apocalypse. The accountability. He's not saying the world will end. He's saying we forgot how to handle risk like adults. We want safety without sacrifice, growth without patience, freedom without responsibility. But those trade-offs don't disappear. They just wait. So what do you do when everyone around you is either terrified or pretending not to be? You do what the wise always do, prepare in silence. You study your expenses until they make sense. You build cash not to hoard, but to strike when prices fall. You stop trying to time the market and start timing yourself. Your energy, your attention, your decisions. You stop scrolling for advice and start building habits. You automate your savings, you keep your portfolio simple, and when panic sets in, you remember, wealth loves boredom, because boredom means you're not reacting, you're observing, you're waiting. The biggest profits aren't made when things go up. They're made when you refuse to sell when they go down. If you ever feel helpless watching markets fall, remember this. The stock chart isn't your enemy. It's your mirror. It reflects your patience, your fear, your conviction. When you learn to stay calm in front of that mirror, you've already won. Crashes don't destroy your potential. They expose it. They show whether you built your wealth on hype or habits. So let the world panic. Let the noise grow. And when it's over, you'll be standing, holding the same principles that outlast every bubble. Because the secret isn't predicting storms, it's building a life that survives them. That's how ordinary people become unshakable. Not through luck, but through discipline. Not through timing, but through trust in time. This is how wealth is transferred quietly, from the reckless to the prepared, from the emotional to the patient, from the many to the few. And that few? They're not special. They're just consistent. So start today, not with panic, but with purpose. Because when the next crash comes, and it will, the only question left will be, were you ready to panic or ready to buy? This is the passive path, where patience becomes power and preparation becomes peace.